Hello everyone. Now let's start with our third module, that is risk and return. So from first unit and second unit you are able to understand that risk and return are the two multifaceted concepts that are quite common in investment management. When we talk about security analysis, it is very important to consider the risk and return analysis of a particular security, whether it is a bond, whether it is an equity share or any other financial instrument. So, with the help of risk and return, we are able to understand what is the volatility of the particular security and how much return we are going to get from that particular investment. So, for a particular investor, according to his expectation and according to his risk appetite, he is going to choose a particular security. So, risk return trade-off is a very important concept in security analysis. So, what we are going to cover under our first lecture, what is risk and what is return. These are the two major components that we are going to explain with the help of our first lecture. Now, coming to the background, why we required a particular investment to provide us with the potential risk that particular investment have, and what is the expectation of an investor, that is termed as return. So, when we talk about risk and return, it is very important every investment has certain risk associated with it or it is inbuilt in that particular security. Whether we could talk about fixed deposit, bonds or stock or any other mutual fund, every security has certain amount of risk. The word risk-free instrument is very common, but that instrument too covers certain amount of risk. So, risk is very important for investment and return that we expect from that investment is also very important. So, that is why it said that a particular investor has different motives, which we have covered in our first lecture, that different objectives or different goals for investment. So, every individual have that particular thing while they are going for investment, but every investor is also considering the risk and return associated with that investment before investing in that particular financial instrument. So, selecting instrument just on the basis of return is not enough, because if certain agents come and say that this mutual fund is going to give you 14% return or this stock is providing 14% return or 10% return, you need to understand the risk associated with that instrument also. So, none of the instruments that are available in the market are risk free. They have certain portion of risk. There are chances that there may be default risk associated with the instrument, but you need to understand what type of risk that particular financial instrument possesses. The fact is most investors invest their fund in more than one security suggests that there are other factors beside return and they must consider it. So, when we talk about this particular, suppose this particular sentence we are talking about, here we are focusing on two things, that individual security is not enough for investment. That is why individual investors try to have certain diversification or they try to have a portfolio or combination of securities. So, they are investing more than one security. That means they are trying to diversify what? They are trying to diversify the amount of risk that individual security possesses. So, it is very important for investor to understand the concept of risk along with the concept of return. Basically, what we generally see that investors or non-professional investors, or we can say the amateur investors, they basically focus on return portion. Yes, share is a risky instrument, they know mutual fund is less risky as compared to shares, but still they focus on return only. So, we need to consider risk also, because risk is important when we consider about the return. We already know that the higher the risk, higher the return, or if a particular security possesses higher potential of risk, they are going to give us higher amount of return. So, with this particular proverb, we are trying to invest in the stock market, but we need to focus on what is risk and what is return actually means. So, in finance, risk and return are the two fundamental concepts that are closely associated. That means They are closely associated. Why they are closely associated? Because whenever we talk about any financial instrument, we need to consider the risk of that particular instrument as well as the return that particular instrument is providing to the investor. Without these two concepts, we cannot go further. So when we talk about security analysis, we are basically considering what is the risk potential of the instrument and how much particular instrument is providing the return to the investor. So these two concepts are very important in finance. Investors seeks to earn returns from their investment, but with every opportunity for return comes the potential amount of risk. So whenever we say that this particular, suppose, share is giving us a good amount of return, the return portion is, if it is high, the risk portion is also going to be high in case of shares. In case of FDs, the riskiness is quite low, or we can say very less. The amount of return is also very less. We know the rate of interest is quite low. So we need to consider these two aspects, that is risk and return, in every financial instrument. So understanding this relationship is critical for making informed investment decision. Why it is so? If we just know about the return, as I mentioned that whenever the agent come to a particular person or they visit a particular client, they basically focus on the return portion. They don't focus on the risk portion. They consider that the investor or the client know about the potential risk. So it is our requirement that we should know which particular instrument is risky and which particular instrument is less risky. So with the help of this particular chapter and further lectures, we are going to explain this particular concept. So this particular thing is very important. These two things are very important for investor so that they can make a better informed decisions. The investors not only like return but also dislike risk. That is a basic thing about an investor. Every investor wants a higher amount of return, but with higher amount of return, they are also expecting a higher amount of risk. So they need to understand this factor, that whether they like or dislike, they have to cover that portion also. So what is required is clear understanding of these two concepts. What creates them? What is the basic fundamental concern about the risk? How the risk is associated with particular security. So we need to understand that particular concept also, and how we are going to measure this particular items, that is risk and return. We are going to cover these two things under following chapters. Now what is return? The basic concept. So return is basically the primary motive of any investor. When we are investing, we are basically concerned that we should get a good amount of return from our investment. But what is this return? This is basically the expectation that potential investor have from a particular instrument. So every particular investor is concerned about return, and the companies either issuing their stocks, or banks, they are issuing the FDs or corporate bonds or any other financial instrument. They need to focus on that particular thing, that every financial instrument, whatever they are supplying in the financial markets, they need to provide certain amount of return to the investors. Basically, they are considering return as their consumption benefit that they are sacrificing, because as I already mentioned in my first lecture, that a particular investor, when they are investing in stock market, they are actually sacrificing their consumption needs. For that particular sacrifice, they require certain amount of benefit from the investment they are focusing on. So whatever financial instrument it is, whether it is very small in amount or very large in amount, they expect certain amount of return from that particular instrument. So it is a requirement of the suppliers who are particularly supplying the financial instruments in the market, that they should provide certain amount of guarantee to the investor that they will get minimum at least this much amount of return, and it may vary according to the security, because there are securities which have no guarantee and there are certain securities which are quite secured. So secure securities like debentures, bonds, FDs, RDs, in case of certain debt mutual funds also, we have certain amount of guarantee, but in case of equity shares or equity based mutual fund, we do not have any sort of guarantee that what market is going to provide us. But for investor, for investment, they required a certain amount of return, that is their basic requirement. It represents the reward for undertaking the investment. As I already said, that as an investor, I am sacrificing my time, my consumption requirement, and there are other potential risks associated with it, that is uncertainty and inflation. So I need certain amount of coverage. This particular return is going to provide me certain amount of coverage out of that. So return refers to the gains or loss generated by an investment over a specified period of time. For a period of time, we mean that for how much period you are investing in the stock market, 5 years, 6 years, 10 years, 1 month, whatever is the period, you required a certain amount of return for that particular sacrifice. It is typically expressed as a percentage. Since investing is about returns, measurement of realized return is necessary to assess how well the investment has done. Realized return is also known as historical return. When we try to invest in a particular financial instrument, we basically interested in knowing what is the historical return or the past return of the particular securities. On the basis of past returns, we are going to assess that particular security, whether it is good for us or not. If it is providing a good amount of return in past, we expect that it is going to provide better return in future also. So historical returns or realized returns are very important aspects of any particular instrument when we are going to invest in that particular instrument in future. In addition to historical returns, we are often used as an important input in estimating future or prospective returns, as I already explained it. Now, if we want to conclude what is return, the return refers to the income from a security after a defined period, either in form of interest, dividend or market appreciation in the security value. Interest in case of bonds and debentures, or we can say FDs, RDs. In dividend in case of shares, and market appreciation in case of real estate, gold and silver, bullion, artifacts, where the capital value of the particular asset increases, that is termed as market appreciation. Now, return can be defined in terms of realized return, that is the return which has already been earned, and expected return, which we expect from the future investment, that is the return which the investor anticipates to earn over some future investment period. Suppose I am investing for 5 years, so what is my expectation from that particular instrument, that is suppose it is going to give me 13% return. So that is the expected return, and realized return, whatever I have earned or whatever the financial instrument has earned till date before my actual investment. Suppose it is provided us 10% return. So on the basis of this, I am going to either buy the security or not going to buy the security. So if it is up to my expectation, then it is okay. If it is not up to my expectation, if I am expecting 13% from a particular security and its historical data suggests that it is only providing 10% return to the investor, I am not going to buy the security. Okay. So in this case, we have to compare the historical returns with the expectation that investor expects from the particular investment. So expected return is predicted or estimated return may or may not occur. Okay, this may be also the chance that if I am expecting 13% return, I have calculated on the basis of certain assumption, it may be proved wrong and this security after 5 years going to provide me only 18%. Suppose I have taken a security, suppose a particular stock I have taken ASA, suppose XYZ company is that, ASA is a particular company which is having a return of 11% for last 5 years. So on the basis of that, I am expecting that my investment is also going to provide me at least 13% return for next 5 years. So what is going to happen? After 5 years, I have to compare this particular instrument and check whether I am getting this 13% return or not. This particular sentence is explaining that estimated return may or may not occur. May or may not occur in the sense, it may occur that I will get 13% or I will get more than 13%, 14% or 15%. It may also happen that I will lose certain amount and I am getting only 10% return after 5 years. So expected returns are the anticipation that investor have from an instrument. So it may happen or may not happen, but in case of realized return, it allows the investor to estimate the cash flows that happen in the past in terms of dividend, bonus, capital gains, etc. that a particular holder of the security have. So he can assess on the basis of that okay, this particular ASA stock has provided 11% return to the investor in last 5 years. On the basis of this, I am predicting that it is going to provide 13% return in next 5 years. It may happen or it may not happen. So investor has to be very critical about this particular calculation. Now coming to different types of return, one is total return where both the capital gains and the income generated from the dividend or interest are added. So principal amount plus the capital gains which we are going to have from that instrument in form of dividends or in form of interest, we are going to add it. Nominal return, the actual return without adjusting for the inflation. Real return is the particular return which is adjusted for the inflation value. So it is going to give you a clear picture what is the actual expectation or actual realized return of the investor. Expected return, which we already mentioned, that is the anticipation, or we can say it is based upon the forecast, historical performance and probability models. The particular analysis has been done and on the basis of that a security is selected that whether it is going to give me that expected return or not. Now, what is current return? Current return is measured as a periodic income in relation to the beginning price of the investment such as dividend or interest generated by the investment. And capital return, the second component of return is reflected in the price change called the capital return. It is simply the price appreciation or depreciation divided by the beginning price of the asset. For assets like equity stocks, the capital return predominates. And thus, the total return of any security, we can say it is a compress of current return plus capital return. Current return are the dividend or interest that the investment generates and capital return are the appreciation that has been done in the markets. So, current return can be 0 or positive, whereas capital return can be negative, 0 or positive. You may lose the whole amount, that means it is already mentioned there should be appreciation, there may be depreciation also. So, you may lose the whole principal amount or you may gain or appreciation of that particular instrument also. So, there may be appreciation and depreciation depending upon the instrument and the market situation. Now, what are the characteristics of return? The first is the magnitude. Magnitude in the sense there may be profit and there may be losses. So, positive and negative aspect of a particular return. So, return can be positive or negative reflecting the success or failure of the investment. So, the magnitude depicts the range that is positive and negative side of a particular instrument, how much we are gaining from the instrument or how much we are losing from the instrument. They vary in magnitude depending on the market condition, investment type and the holding period. For how much time period we are holding the instrument and the market situation at the time we are selling the security or it is maturing from the market. So, we have to consider that thing also. Time frame returns are often measured over different time frames, that may be daily, weekly, monthly, half-yearly, yearly, quarterly, whatever the range you are selecting, you can check the your expected return is actually matching with the actual return in the market or not. So, is commonly expressed, the annualized return is common way to express return over periods longer than a year. Okay, so when we talk about more than 1 year, we are focusing on the annualized return, because here comes the concept of 1 year. Risk adjusted return, the third component. This considers not only the return itself, but also the risk taken to achieve that return. Higher the risk, higher the return. So, which type of security you are selecting depending upon your risk appetite. If you are selecting a highly risky instrument, in that case your return portion will also be high. If you are a risk aversive and you are selecting bonds or debentures, in that case your risk appetite is low and the return you generate from the instrument is also low. So, higher risk generally demands higher return to compensate the investor. Risk and volatility, investments with higher potential returns usually come with higher risk and more volatile returns. Compounding effect, when we talk about investment, compounding is a major factor. Returns can be compounded over time. Compounded in the sense, suppose I am investing 1000 rupees and it is providing me 10% return every year. So, next year how much is going to be invested? 1100 rupees. Similarly, it is going to be compounded. So, compounded return or compounded effect is already inbuilt in the concept of investment. Benchmarking, returns are often compared as a benchmark. We can, as I previously told, that if a particular instrument like ASA company is providing historical return is suppose 11% and ABC company is providing 11.5%. On the basis of this comparison, I can select that ABC company is providing better returns. But for security analysis purpose, we need to cover the we need to assess the risk also. Just on the basis of return, we cannot consider this particular security. We need to compare the risk of the security also. But for benchmarking purpose or for some general comparison, we can calculate the historical returns and we can compare it easily. Now, coming to the concept of risk. What is risk? In general terms, it is a variability from the expected return. So, if you are expecting 13% return and you are getting 12% return, that means there is a chance of risk associated with the instrument. So, risk refers to the chance that actual outcome or the return from an investment will differ from the expected outcome. So, what you are expecting, the actual outcome is suppose 12% and you are expecting, from our previous example, we can say we are expecting 13% return from the instrument and we are getting 12%. So, there is a risk associated with the instrument. Risk in finance refers to the potential for loss or uncertainty surrounding the return on an investment. It reflects the possibility that actual return may differ from the expected return, including the chance of losing some or all the amount of investment. There are securities or there are investments in which the investors lose their money if they don't go for proper security analysis, because actual return may vary and it depends upon the market condition, investment type and the time period for which we are holding it. So, it may happen that expected return, whatever you have thought and calculated, the assumptions you have taken are different and the actual situation may vary, and in that case the investor may lose the money. Risk is inherent in all investment and understanding its characteristics is essential for effective financial decision making. With reference to firm, risk may be defined as a possibility that actual outcome of a financial decision may not be same as estimated. Suppose a particular firm is investing in certain projects, in that case also there are chances of risk associated with that project. So, risk may be considered a chance of variation in returns. So, if there are chances that returns may fluctuate or vary from the expected, it is termed as risk. Example, if you invest in a stocks, its price may fluctuate daily, meaning there is risk you might lose your money if the prices drops. So, risk implies the extent to which any chosen action or inaction that may lead to loss or some unwanted income. The notion implies that choice may have an influence on the outcome that exists or has existed. So this is a particular diagram on the basis of which we can see that the x-axis is showing risk and y-axis is showing the return. We can see there are securities like small savings in banks or bank deposits have low risk and low return, when there are securities like equity shares and convertible debentures which can be converted into equity shares depending upon the company. If they are issuing it, they are more risky and they are providing more returns. So on the basis of this, we can categorize the instruments and check which particular instrument is providing higher amount of risk and which instrument is providing lower amount of risk. Now coming to the characteristics of risk, the first characteristic is uncertainty. Whenever we talk about risk, we need to check it with the concept of uncertainty. Because there is uncertainty, the risk is associated with the financial instrument. If there is no uncertainty, if we know exactly what is going to happen, the chances of risk might be very low. But since there is uncertainty of the financial environment as well as the political situation or the economic condition, the investment may have certain amount of risk associated with it. So fundamental nature of risk is uncertainty about future outcomes. This uncertainty may arise from various factors such as market volatility, economic factors and political events. Variability, risk is typically associated with variability in returns. Higher the potential of variability, higher the chances of risk, and lower the chances of variability, lower the chances of risk. Potential for loss, risk entails the possibility of financial loss. When we are talking about greater chances of variability, that means greater amount of risk and greater amount of losing the money is associated with it. So where the actual return or investment could be lower than the expected or even negative, investor demanded risk premium associated with it to compensate for potential losses. But in that case, if the losses incurs in that situation, the investor may lose their money also. Risk return trade-off, there is a direct relationship between risk and return potential, usually associated with higher risk, higher return. So trade-off means that to achieve greater profits, an investor must expect a greater amount of risk, otherwise he is not going to get greater amount of return. Time horizon, the amount of risk an investor is willing to take often depends upon the investment time horizon. If the longer the period, the more the risk, because investor has to cover the time loss also and it will take lot of time to recover from that losses also. So first we have to cover the time period so that we can get a better profit, and for that purpose also we are going to lose the money. The investor, while short-term investors may prefer lower risk to protect their capital amount. Measurability, risk can be measured using various statistical tools which you are going to study, standard deviation, beta, value at risk and other measures are available to quantify the amount of risk associated with the instrument. Diversification, it is a major component when we talk about risk. If we diversify our portfolio or diversify our investment, we are going to minimize or mitigate the amount of risk associated with the instrument. So we need to identify the instruments which have negative correlation. We need to identify different industry, different geographies where we can diversify the investment. Perception, the risk perception varies from one investor to another investor based on their risk tolerance, investment goals and psychological factors. Some investors are more risk averse while others are less risk averse. So depending upon their risk perception, they identify the investment avenues. Systematic and unsystematic risk, which we are going to cover in next chapter. Systematic risk, which is market risk, and unsystematic risk, which is firm specific risk, which we can diversify. So with this, we come to the end of this first lecture. In next lecture, we are going to talk about systematic and unsystematic risk. Thank you.